This is Brant from Wolf on Wall Street Trade. Let's just get right into this. Last weekend, I said we do have this ascending triangle here that you can see. That's a bullish consolidation continuation pattern. It broke out. It did hit 4,100. 4,100 is resistance for a few reasons. It's resistance because of a level back in September, which is right over here. It's also a primary downtrend point of resistance, which you can see on this daily chart here, right there at 4,100. And then there's just the fact that 4,100 is a round number, and that makes it psychologically important. So we don't even notice this, it's just part of how we grew up. But if you go to a store and you see an item that's marked $9.99, so it's 1 cent less than $10. It'd be easy to put $10 on there, but retailers have known for a long time that the human mind is attracted to whole numbers. So $9.99, even though it's a penny less than $10, sounds less than $10. It has a psychological effect. So in any case, 4,100 being a round number is also a form of psychological resistance. So in last weekend's video, let me go back to the ascending triangle. Hopefully you can see it right here. And it's happening right where it should happen, because 4,000 was the last measured move target. And the most common thing to happen once we hit a measured move target is for price to consolidate in that area, which it did right here in 4,000. Broke out. So last weekend's video, I warned that this is still a bear market rally, and you have to really be on guard. You can't let your guard down. You can't get complacent. What I warned of is the potential of what I call a false breakout or even a false breakdown. So in the case of a false breakout, it might be helpful to consider that as a head fake or a bull trap. And in the case of a false breakdown, you might consider that as a bear trap. So this is really the most important point of a breakout. But first I want to address this ascending triangle. You really have to look at these consolidation patterns as basically the market taking a moment, shaking out weak hands, and gathering strength again. So I view these conceptually as like a spring that is just coiling up, gathering energy for this eventual breakout. I don't know if this analogy will help at all, but imagine you have a group of friends and maybe you're going on a hike, or you're going to climb a mountain or something like that. And you've been preparing in the gym, you're getting ready for that. This is the preparation stage. And then you go on the actual journey. That's your breakout stage. Now, imagine you have one person in your group who's like, oh gosh, after this thing, I'm just tired. I need to rest for a minute. It's like, well, hey, we just got started. Well, let me just rest for a minute. So sometimes you'll see prices come back down and they'll rest here. One of the ways we can judge a breakout and the health of it, and this is really the most critical part, is how impulsive it is, how far it moves out of this zone. And this looked actually pretty good on this Wednesday after Powell. But you can also judge by volume. Volume should decline during the consolidation, and it should pick up on the breakout. So with that activity, you should see conviction. So now imagine your friend is like, okay, I just need to take a break here and rest. And then your friend says, well, you know what, I'm just going to go back down to the car and get some water. That's kind of this stage where price is pulling back. This is where you're now in danger of a false breakout. And a false breakout tends to be followed by a fast price reversal. So your friend goes back to the car and gets some water while you guys are sitting there waiting at the first plateau of this mountain you're climbing. What are the chances that your friend is going to have water and is going to jump back up that mountain and rejoin you? Chances are better that that person is going to get in their car and go home. That would be the fast reversal to the downside. So that is what happens with false breakouts. In this case, you would consider this the bull trap, where new longs jump in, they're excited, then all of a sudden they're at a loss. And as prices turn down, they're at a bigger and bigger loss, and they start selling, and that perpetuates more downside. So that was the risk this week. If you remember, then you already know, why. If you only see these videos on the weekend, you don't get these intraday updates. So Monday morning, we already knew the reason why. It was the Fed Whisperer at the Wall Street Journal, who's kind of like the unofficial mouthpiece for the Fed. The Fed is in media blackout because they have the FOMC meeting this Wednesday. They can't speak to the media. So what they tend to do is they don't want to surprise markets. They leak stuff, and they leak it to this one particular person at the Wall Street Journal. That's what came out Monday morning. And basically the leak was, you don't really know it's a leak because he's not going to say, hey, they leaked to us, but he comes out with his article. Because of the wage inflation in the payrolls report, that was like twice as much as was expected. And there are some Fed former economists and advisors who said they think that wage inflation is actually severance checks to people who are getting laid off, and that's why it bumped up. But regardless, the wage inflation in his article from the payrolls report was seen as a potential for the Fed to keep the terminal rate either higher than 5% or at 5% for longer. Now, there's reasons to doubt that, but for now, that's what we have to go with, and that's what the market's responding to. So I could change this trend line, but I see that price is really respecting it. You can see here it's respecting it as resistance now. It was support, now resistance. Let me show you the NASDAQ real quick. So the NASDAQ had this bull flag with a breakout, and then this is the pullback. This level right here is the NASDAQ's inverse head and shoulder base neckline. So it's an important level, and you can see, again, price is kind of respecting that. It's an important level. Now, I always say to my members, or I've been saying more recently, don't get lost in the lines, because when you see something like this, you have a bias. The bias is it's a bullish consolidation, but price develops, things change. So you always are better served by looking at it with fresh eyes, taking off the trend lines, and that's what I did this week, and this is what I came up with. And basically, that is a rectangle consolidation. A rectangle is a consolidation continuation pattern, but it has no inherent bias like a bull flag or like an ascending triangle. Its inherent bias is determined by the preceding trend, which was up over here. So if this is a false breakout, it's very, very small right here. So I'm not sure I would attribute this as being high probability false breakout, but still, we can see what's happening with the S&P, and there is a risk of that. And jumping back to the S&P 500, you can see why I have no reason to change these trend lines into something like a rectangle, which really wouldn't be appropriate anyway. And if I did, we'd still have the potential of a failed breakout over here. But the reason I don't change them is because support here, resistance there. Price is obviously respecting that trend line, so no need to change it. Now, we do have a major dichotomy. Price always matters the most, but there's things that we use, tools, indicators, to give us an idea of what way price is going to go or to judge the health of a breakout. So volume, we should see volume contract here, volume expand here. It did. And this was actually a pretty good breakout. There's indicators that we use, but they're all just tools to tell us what the probabilities are of price doing one thing or another, and to judge something like this, like how strong was this breakout. So the dichotomy is that we have some incredibly strong market signals that contradict or contrast price. I'm going to show you a few of those real quick. One is just the 3C chart of what's been going on here. So as we've been pulling back, we have a positive divergence. Okay, so that's one thing. Another thing is high yield credit, and in particular HYG, because it's deeply, deeply liquid. So institutional traders will use HYG as a proxy for like S&P futures. HYG rarely gives strong 3C signals, but we did get that this week. And the perspective of this chart, it's a little bit harder to see, but for subscribers who are watching this develop through the week, a relative positive divergence, and then into the lows of the week, it was leading higher. Then price started leading higher. So if we look at HYG's price relative to the S&Ps, and this is the S&P in the candlesticks and HYG in blue, you have to keep in mind they do not have the same beta. So if the S&P is up 2%, HYG is not going to be up 2%. You have to look at it in terms of relative price trend. So over here we see the S&P making a higher high. We see HYG not doing so. We get a pullback. Okay, over here, this is a very modest positive divergence in HYG. Actually, we had one right here that gave us a pullback, but very modest positive divergence. This was before that big 3% one-day move in the S&P 500. So what I noticed is as the S&P came back down to these levels and below, HYG did not. Relative strength here, and then even more as the week developed. This is a pretty darn strong signal from HYG, and it's one of my favorite market leading indicators, market-based leading indicators. Now we're going to look at the 10-year yield. This is this huge uptrend from August that really hit the market, but this is also where we got that base starting in September into October, and this pullback is where we got this most recent rally where, the Dow gained over 20%. But these are bear flags here and here and here, and then a small bearish descending triangle as we came into the week. So we did see a pretty decent bounce in yields, but it has not changed the trend. So yields and the stock market have had an extremely strong inverse correlation. Yields fall, the market tends to do better. So I think yields are still in a good place. They're still in this downtrend, even though we got this bounce this week because of that WSJ article, and then the PPI came in a little bit hotter than expected, and that's making people worry about the CPI print next Tuesday, which is just one day before the FOMC. My opinion is with the S&P hanging out right below this, I don't think we're going to get this resolution that either says we're going to invalidate this potential failed breakout fast reversal by moving up. I don't think we're going to get that Monday. I don't think we're going to get it until at least we see the CPI report on Tuesday. And if inflation does continue to come down in the CPI report, then we may see that. But if it's just at consensus or a little bit higher, then nothing's going to happen until the FOMC on Wednesday. One other leading supportive indicator I want to point out, other than high yield credit and other than actual treasury yields, is going to be the US dollar index, because like yields, it has a very, very strong inverse or negative correlation with the equity market. Now, I do want to give you a warning. That has been the case since the end of the COVID crash in 2020. But that's not always the case. The dollar has three different relationships with equities. So to say that it's always inverse is not correct. But right now, it is strongly inverse. Before I do that, since I have this pulled up already, I'm just going to show you what I was just talking about with yields being in that short-term downtrend and being supportive. This is S&P futures in the candlesticks, red and green, and this is the 10-year Treasury future in blue. So Treasury futures move opposite yields. So we can look at Treasury futures and see that they are still leading or positively dispositioned for the S&P. They're still leading higher or positively divergent. So let's go to the dollar. So again, S&P futures in the candlesticks, and this is a 2-hour chart. And in blue, we have the US dollar index, but I've inverted the price because of that negative correlation. So this line falling is the dollar actually rising. And you can see what happened with S&P futures as they tagged that 200-day moving average or the benchmark index, and the dollar started rising. The dollar led on this chart S&P futures and the market lower. If you look over here where the market bottomed, the equity market, this is dollar weakness. It's a higher low. That's a positive divergence, and that led this current rally that's seen the Dow gain over 20%, and people call that, Dow's in a new bull market. That's not the point, though. The point is the dollar is, its weakness on this chart anyway, is leading higher. So it's leaving a lot of room for stocks to gain more. So the last time the dollar was up here, or down here rather, the S&P was trading around 4,300. So the point is we have two very different looks. One is price action. That matters the most. But then we have leading indicators, whether they be stuff like 3C, my own indicator, or whether it be high yield credit, whether it be treasury yields, or whether it be the US dollar index. Those are all pointing in a positive direction. But Like I said, I don't think we're going to see a resolution until the CPI report Monday. And if that is not decisive, then we're not going to see it until Wednesday with the FOMC at 2 o'clock and then Powell at 2:30. And I think this meeting we also get the SEP. So I'm going to leave it at that. If you are a subscriber, you already know this stuff. So if you're seeing these on, the weekends, there's a lot that happens. Like Monday morning, already knew there's going to be some major changes this week. Otherwise, I'm trying to pass along some of these concepts so you can apply them. And they all are fractal. So it doesn't matter if you're a long-term investor. It doesn't matter if you're a swing trader. It doesn't matter if you're a day trader. All of these principles apply. You can apply them all to your trading. And that is what's important to me, is to pass along concepts that everyone can use. Hope everyone enjoys the rest of their weekend and has a fantastic week ahead. For members, I will see you on Monday.